right. So welcome everybody. My name is Kyle Orwick. I'm a partner with Eide Bailly and our transaction advisory team. I've been with Eide Bailly a little under 10 years, and I've also spent 3 years working abroad in Germany for an accounting firm over there in the mergers and acquisitions space. My team specializes in due diligence, quality of earnings, net working capital, earnouts, and anything accounting related of the transaction, including tax structuring. And industries that we typically work in are manufacturing, construction companies, industrials, business services, consumer products, and typical kind of privately owned, closely held businesses. Deal sizes that we work on are kind of in that middle market, anywhere from 5 million to 200 million in enterprise value, which kind of your run-of-the-mill manufacturer of revenues ranging from 10 million to around 200 million as well. Excited to be here today to talk about a specialized topic with net working capital.
And I'm Chad Flanagan. I work in our business valuation group, and we do business appraisals. A lot of times we'll do those for transactions. We'll talk a lot about transactions today. I also do them for gift and estate tax planning, sometimes litigation support. And then we also work with clients to help them build the value of their business and work with them to improve earnings, improve cash flow, decrease risk, and working capital can be a significant component of that. So I'm glad to see so many of you on today. Kyle and I thought we were the only ones that got excited about working capital, so I'm glad to be proven wrong on that, and great to be with you today.
So we have kind of three primary topics, and the first of which is the kind of fundamentals of net working capital or fundamentals of working capital. We'll kind of go through some definitions, terminology, some basics around different uses and different reasons for net working capital, and really when people are talking net working capital, trying to apply it to the specific instance. Chad will then discuss some areas impacting valuation, operational efficiencies as you're owning that business, and then I'll lead out on the kind of deal implications of net working capital and how to make sure, I used to call it the six steps of winning net working capital, and now I think it's just the 6 steps of surviving net working capital in a deal. So some quick definitions to get everybody grounded. This is just pulled from Investopedia.com. Working capital is known as net working capital. It's the difference between current assets and current liabilities. Paraphrasing, it measures the company's liquidity, operational efficiency, and its short-term financial health. The site goes on to say, if a company has substantial working capital, then it should have the potential to invest and grow. If a company's current assets do not exceed its current liabilities, then it may have trouble growing or paying back creditors or even go bankrupt. And this is technically, this is probably what you will read in your accounting workbook or accounting textbooks and your finance textbooks. This is what you'll read about in the Wall Street Journal for publicly traded companies. It's a way to kind of measure things apples to apples. It includes things like cash and includes items like debt. And certainly if your debts your short-term debts far exceed your current cash flow, then you may have trouble. But if you think about this from an industry-specific perspective, if you have a technology company that has a significant amount of deferred revenue because they collected a whole bunch of cash in advance, that actually might propel them to grow faster and with less need for traditional financing sources. So really kind of have to put things in perspective, and I think those are just a couple examples, and I'm sure we'll get into more here.
Yeah, we'll talk about how important working capital is in transactions, but we think it's an area of consistent controversy and dispute. And one of the reasons for that is that there's so many different definitions for working capital. For all the auditors on the call that live in the financial reporting world, GAAP really helps provide some authoritative guidance around what is working capital. we all know working capital is current assets less current liabilities. But what is a current asset? What is a current liability? Oftentimes we'll see buyers and sellers fight on that issue. So GAAP can be a really good resource. It can often be referred to in purchase agreements or LOIs to be that overall guidance to help provide some middle ground for buyers and sellers. One size fits all approach. We also see that in the valuation world where, it's a fair market value type of approach, willing buyer, willing seller, very similar, we think, to the GAAP definition. And then we kind of get to the transactional definition, which can be anything that is negotiated. So there we see buyers and sellers deciding together what working capital should look like as they put together a working capital target. It's important that they get on the same page. So that can work really well. We've seen some clients put together schedules and really talk through each of those items, but things can come up. Sometimes it's a warranty issue, sometimes it's unearned revenue types of things that weren't anticipated that come up at close. And so that true up can sometimes be an area where clients will need some help to provide a tiebreaker on those kind of things. Kyle's done some of that work and maybe talk about that a little bit later. So again, just be aware of lots of different definitions and important buyer and seller get on the same page. So with that, we have our first polling question. Amy?
All right, so our first polling question here, what is net working capital? You do have a couple answers you can choose from, so you should see a box in the middle of your screen that allows you to pick.
This is the answer we kind of usually get, and you're right, it's the technical answer. But as a business owner, I would argue that net working capital is money that business owner has invested in that business. In a deal specific net working capital, the letter of intent 9 times out of 10 says current or working capital without cash or debt. It just kind of goes back to understanding the framework for when you're talking about net working capital, and Chad's told me before, this is a trick question, so that's probably true.
They get easier though, right, Kyle? The next questions. All right, well, I would like to just talk through a little bit how working capital impacts our valuation approaches. It's very important to understand future working capital needs, and they come into play differently in each of these approaches. So a little bit of BV 101 here. We have 3 approaches available to us: the income, market, and asset approach. And the income approach really is just looking at a business like an investor would an investment. It's wants to know, what is my cash flow, what is my return on investment, and what is the risk associated with achieving that return. So we'll talk a little bit more about that. The market approach, which is one of the best approaches. In the market approach, we're looking at comparable type companies. What can we learn from transactions of those companies that we can apply to the subject company? And then finally, the asset approach, probably the most straightforward. There we're looking at the assets and liabilities of the company, looking to the balance sheet and restating assets and liabilities to fair value or fair market value. So working capital impacts each of these approaches differently. With the income approach, there we're converting earnings or net income into cash flow. So we'll talk throughout this presentation about how cash is king, that at the end of the day, that's what a buyer wants, is to know cash flow that they can either take out of the company in form of a distribution or plug back into the company to help grow it. So we can't stop with just earnings or net income. We really need to convert to cash flow, and working capital is an important part of that. In the market approach, there we really need to understand, after we apply a multiple, what then do we have? Do we need to add some working capital components to it? And what sort of adjustments do we need to make in that approach? And then the asset approach, very much the most straightforward. There we're focusing on the quality of those assets, receivables, inventory, payables, things like that. So we'll show examples of each of those, and we'll start with the easiest. We'll start with the asset approach. And this can be an approach we commonly use for asset-intense businesses. It could be manufacturing plant, could be agriculture related, something where there are a lot of tangible assets, PP&E, inventory, those kind of things. And it's one of the most commonly used approaches because it's very straightforward. We can just take the balance sheet, make some adjustments to it, and look to see what the equity is. And in this case, we have adjustments that we made. You know, we can look at accounts receivable and looking at an aging schedule and say some of these may not be collected. This is a negotiation maybe between a buyer and seller. Same with inventory. There's maybe some obsolete inventory, some testing that Kyle's group will do sometimes in due diligence procedures. But at the end of the day, we're just trying to adjust that book value section to fair market value. As we look at the market approach, you know, I mentioned this situation of applying multiples. This is commonly used, and what we hear more than anything is, hey, my buddy sold his business for 5 times EBITDA. So, you know, I'm going to try to do that. But the question we need to ask after that is, what did that include? What were the deal terms? And what do you get with 5 times EBITDA? Because sometimes that can mean a stock transaction where all assets and liabilities go with it. And sometimes it might just mean that goodwill, fixtures, and inventory go with it. So here's an example where in the top right example, that's what the multiple meant. And we will go to the source of the multiples and actually recreate the deal price and calculate the multiples to make sure we understand what's in the deal. And if it is truly just an asset deal where it's just the operating assets of the company, to compare that to the deal in front of us, we just need to add and subtract liabilities that are going with this particular deal. So we'll, in our valuation world, we'll value equity a lot of times, and we'll add all other assets and subtract all other liabilities. And then on the bottom, if we are using stock transactions, we apply that multiple, and it really gets us almost everything within the company. The only thing that usually doesn't go in a deal like that is some non-operating assets. Could be some artwork in the lobby, could be a boat that you have in your business that you need to take out before you sell it. So very few adjustments with that. And then finally, the income approach. What's important with the income approach is really 2 considerations. One is that working capital will impact how much cash flow we can take out of the business. So a lot of growth in a company means inventory, receivables, some of those things will be increasing in correlation to revenue. And as it increases, it requires us to leave more of our earnings in the business. And so it can actually be a detriment to the value of a business. On the other hand, if there is any excess assets, any excess working capital, we can dollar for dollar add that. So you can see in the example here, we start with normalized pre-tax income, we apply taxes, and then we subtract some working capital needs. We'll go into how we actually calculate that. From there, we use a cap rate, and then there's a spot there to add any non-operating assets, or could be excess cash, could be a dollar for dollar increase or decrease to the value of the business. So we'll go through kind of how we look at those and analyze that. The first is just looking at, hey, what will those working capital needs be? This is one approach to look at that, and kind of there's a lot going on here, but if you look just to the operating working capital and then compare it to revenue, we can look at 5 years and come up with an average of 7.8% working capital to revenue. So now as we look to how much is revenue going to grow next year, we can apply a growth rate. We can calculate that revenue is going to increase 2.4 million. And if we maintain that ratio, our working capital needs will grow at a 7.8% ratio. That means almost 200,000 of our future income will be tied up in increases in the inventory, receivables, and other net working capital. So that gets into the weeds a little bit, but as you look at that 186,000, that then goes back to our income approach, and it deduct from the earnings to calculate working capital or to calculate net cash flow. So just something to be aware of. We see this with buyers that do discounted cash flow models. They will account for the idea that not all the earnings can be distributed back to them or plugged back into the business. Some of it will be tied up in working capital increase. One thing that's helpful for us in that is looking at trend analysis and benchmark data. So we can look to the industry to say, how do they compare? Some of the metrics here you may be familiar with: current ratio, quick ratio. Those are just current assets divided by current liabilities. The quick ratio is without inventory, so that can be a good gauge on liquidity. I already talked about working capital as a percentage of revenue. And then the big three are receivables, inventory, and payables. So a lot of what we're trying to do here is project what working capital will be in the coming year or two, and analysis of trending and also comparison to industry can be a useful tool in that. Another thing we like to look at is called the cash gap. The cash gap really just shows us how we're financing our working capital. So we calculate days in accounts receivable, add days in inventory, and subtract days in accounts payable. So the first two, the inventory days and the receivable days, think about as you start your business. You buy inventory, it takes you 28 days to sell it. So you've got cash tied up for 28 days. And then once you sell it, assuming you sell it on credit, it takes 65 days to collect on that receivable. So that's a total of 93 days before you get anything back. Fortunately, you can delay payment to some of your vendors, and in this case, you can defer that 68 days. So 93 minus 68 is 25 days. That's how long you're financing your working capital, and we'll work with clients, and the impact of reducing 25 days to 20 or 15 can be pretty significant in their cash flow needs and their liquidity. If you think about different businesses, this can be a very high number for some very inventory intense companies, and on the other end of the spectrum, there are some that have negative cash gap. If you think about colleges or universities, maybe they get paid before they incur their expenses, and they actually have a favorable cash gap situation. So some of this is based on the industry you're in, but anything you can do to improve turnover and receivables and inventory and defer payment on payables is a good thing. And I should say that's a good thing for cash management. There are some other considerations with that. I like to show this slide. There's literally books written on each of these, right? Inventory management is a whole subject in of itself. When we look at inventory metrics, we hear clients sometimes say, yeah, I get it, just-in-time inventory is great, but I need a wide selection for my customers. That's why they come here. We understand that. So there's kind of cost benefit with a lot of this stuff, but looking for some efficiency in inventory turn and reducing the amount of your money tied up in inventory, it can be a very good thing. So just some common sense type of things here. We had a situation with a client where we had them hire an inventory procurement manager, and it was a hit to payroll, but just reducing the days and getting more efficient with management of inventory saved them more cash than they were going to spend on payroll. Accounts receivable, very important there. Just, a lot of times communication can be key. Consider if you have some late paying customers, if you should give some early pay discounts. Just a couple tips there. And then payables, we have some clients that pay their bills as soon as they get them. We'd like you to take advantage of those discounts if possible, but if not, stretch that out a little bit. And of course, I give the disclaimer, don't do it so much that you impair your relationship with your vendors. Maybe that's an accounting firm. Maybe that accounting firm needs to get paid. Certainly not encouraging stretching that too far. I'm going to show you an example of when we work with clients and help them build value. We'll sit down with them and try to identify some areas, maybe through the analysis of industry benchmarks, we identify some areas they have some shortcomings. And the easy stuff is to say, let's increase revenue, let's increase margins, let's reduce overhead. And clients get that and are working on those kind of things already. But the asset management piece is maybe forgotten sometimes that, hey, if you found out that you've got significantly higher days in inventory than the industry average, let's dig into that. Let's figure out if there's a way to improve it. And that can really increase cash flow. And then just some closing thoughts as we look at working capital and how it impacts valuation. We'll talk a lot about how cash is king. We're really trying to efficiently work our working capital so that we convert it to cash as soon as we can. And kind of jumping around here, but or maybe Kyle just wants me to be done and he's advancing the slides.
I don't know what's going on.
But Kyle can talk about this a little bit further, that it's such an important part of due diligence to understand the trends. We understand seasonality. As a seller, we want you to be able to pull all of that out and convert some of those working capital items to cash. As a buyer, we want to make sure as soon as you buy this, you're not underestimating working capital so that you have to draw on a line of credit within 60, 90 days. So really the person that does the most analysis understands those working capital needs can sometimes win the day. And it's just important to understand due diligence and how that impacts value. So with that, we'll go to our second polling question.
All right, so the second polling question, calculate the cash gap using the following information. Go ahead and pick which day you believe it to be, 26 days, 34. Oh, looks like we have 34 twice, and then 84 days. So while you guys answer that, Kyle,
Is
you
that a
have
hint,
control.
We want to add the AR and inventory and subtract the payables.
Right.
Nothing like a good math question over lunch break.
All right, guys, go ahead and answer that for me. Just get a few more of you.
And I'm just going to say we needed that C 24 days, I think. So,
yes.
But maybe the third one is still correct.
Just a typo on our side, no worries. All right, here's your results.
All right, so this is our kind of third and final topic of the afternoon, and really kind of the mergers and acquisitions aspects of net working capital. Kind of two primary objectives with it, or two kind of conversation pieces with it. And the biggest part of it is to drive that value. As you're selling a business, or like Chad kind of alluded to or mentioned in the last part of his discussion there on valuation, is as you're selling a business, if you can reduce your net working capital by $500,000 in that example prior to closing or leading up to a sale, that's value that goes right home to the seller's pocketbook. And even if it's rather recent that was able to occur, likewise, if a significant customer of yours increases your terms from 60 to 90 days, that might be value that you have to that's eroded through the deal. So these things are very impactful, and kind of understanding them is kind of paramount, I guess, to like I said, winning or at least surviving the net working capital discussion during the transaction, because it's probably the least understood part of a transaction. Everybody understands this EBITDA multiple, 4 times, 6 times, whatever it is. People understand the asset versus stock deal. Those are the other two primary items within a value. But then the net working capital there's always this blank line in the purchase agreement in the first and seventh draft that says we're going to work towards in the letter of intent. It usually says we're going to work towards a normalized level of working capital on a cash-free and debt-free basis. So with that, it's always left as a blank number versus the purchase price says 30 or 40 million. That number is left blank. So your kind of seller might be left wondering what that means and how is that going to impact the final proceeds of my deal. So it's just something to maybe think about a little bit further in advance if you're the seller. And steps 1 through 4 here, I'm not going to, we'll go through each one of these steps in great detail or in some detail. But steps 1 through 4 really outline, how things are going to be measured and what that normalized level of net working capital really means to set the target net working capital, or what some people sometimes call a PEG for the net working capital amount to be delivered. And so just for some framework here, the net working capital target is really meant to deliver a certain amount of assets within the business, a certain level of net assets, including net liabilities or net current liabilities, that keep that cash flow going in the current valuation as it was currently valued. Chad mentioned the income approach, and if a private equity group is running a discounted cash flow, they're valuing that business based on some sort of cash flow metric and a multiple of what they're willing to pay. It includes net working capital. They don't want to pay based on a cash flow amount and then have to come in and then fund 100% of the net working capital need of that business. So that's kind of the business purpose, or the reason why these purchase agreements include net working capital, and that's kind of just maybe important to kind of frame up the discussion here. We'll go through each one of these steps, helping to set the definition of and methodology within the net working capital, layering on any pro forma adjustments to bolster the calculation to bring it to kind of a current view of net working capital. Some things might have recently changed. Then kind of analyzing the business cycles and what the growth plan is of the business in step 3. Negotiating in that phase. It all comes down to a negotiation. There's no right number for net working capital in the target, just like there's no right number for the valuation. This is a negotiated number, and setting that number higher sometimes is better for the buyers, and lower is better for the sellers. So it's a part of the negotiations. But then steps 5 and 6 are kind of the remeasurement periods, and we'll go through a couple of working examples there on how it gets compared against the target, that negotiated number. So in step 1 here, just outline kind of a balance sheet, and it looks a little bit similar to a normal balance sheet, and it's done on a monthly basis, but it's repositioned a few accounts. So it's repositioned the cash below current working capital, because most deals, or 90% of the deals we work on, are cash-free and debt-free transactions. So the seller gets to take home all their cash, but they have to pay off all their debt and debt-like items at closing. Then they're supposed to deliver that working capital assets and assume the working capital liabilities, and those numbers then get compared against that target number. And you use kind of, a lot of times you get to use monthly numbers because it evens things out. The net working capital number might change by $1 million, $2 million in any given month. But a lot of transactions will use a trailing 12 months, a trailing 6 months average. So you kind of schedule things out monthly. And here you have the reported numbers, and these are basically the line items within the financial statements. These are unadjusted numbers. These are just purely from the trial balances as stated, as kind of this is the building blocks, and this is the first building block for negotiating that net working capital target. Other receivables is excluded, even though it might be a current assets in the financial statements. It might be a related party receivable. And some examples, they're within accrued expenses. There might be, there could be credit card liabilities, and those credit card liabilities that are, reoccurring balances, those start to look more like debt, and you might be able to move those down in the section of long-term debt or capital lease obligations. And the more that the buyer can reposition below working capital liabilities and successfully argue that those feel and smell like debt, then they can get the sellers to pay off those balances at closing. So that's real value that the seller doesn't get to keep, and it's liabilities that the buyer doesn't have to assume. So that's those are value drivers, and so it's kind of where do things fall out in the mechanism to include or exclude liabilities. And it's one thing to schedule this out, and then you have to make sure your definitions within the purchase agreement outline these things specifically, that maybe you have accounting rules as an exhibit within the purchase agreement that say specifically what is included, excluded. There's lots of ways to kind of work through this first step. Then we move on to step 2, defining any adjustments to the net working capital. This top line of reported net working capital comes right from the current working capital liabilities minus, or current assets minus current working capital liabilities. So you get to reported number, and then you start to tack on normalization adjustments. So in this case, we have a couple examples. A customer changed its policy from 60 to 90 days, as I mentioned before. So it really impacts the old periods a lot, but it still impacts the current period in the trailing 12 months by $100,000, and adding to the level of net working capital kind of required to fund that business. Retainage, payables and receivables, that's kind of a usual amount within, this is a construction example, to include those line items within the net working capital definition. But in this case, there were just some really, really old projects that had receivables outstanding and payables outstanding that, those are really unusual circumstances. So kind of carving those out of the subledger. This company only started counting inventory in May 2018. So figuring out what the historical amounts of inventory should have been to renormalize those amounts that didn't exist in the trial balance before. Adding in accrued payroll that wasn't accrued. They had some dated payables from a year or two ago, I guess. And, those should be paid off. They feel like debt. They're not really part of current liabilities if they're really that old. They feel a lot more like debt. And then there's some related party stuff, and you really just want to kind of clean out any related party activity in the working capital calculation. So that kind of gets you down to, here's now we had the reported net working capital in step 1. Now we have the adjusted net working capital on a monthly basis. And, it's scaling up, but we'll kind of go into that here shortly. So after you've figured out what your reported and adjusted net working capital levels are, then you kind of have to start thinking about, okay, how is this business functioning? If it's steady state, if everything is kind of vanilla over 12 months, a trailing 12-month average might be the perfect scenario to use of the adjusted amounts. If this business is ramping quickly, if it's got 20, 30% growth in every given year, then the net working capital that you're sitting on over the last 12 months probably isn't enough to fund the business and that cash flow that you're basing your purchase price on and the valuation on. So you might shorten up that time window of how you determine the average net working capital. Chad mentioned previously there was a business that over the long term used 7.8%, I think he referred to, of net working capital compared to revenue, and that's one way to do it. And then look at, okay, the monthly revenue now is at $5 million, so $60 million times 7.8% might be a good way to judge the current view of the net working capital requirements. At the end of the day, there's no, as we move through steps 1 through 4, it's more and more gray versus black and white of what and how to do this. In the bottom example, you can see there's the difference between the trailing 3-month average compared to the trailing 12-month average is about $1.5 million difference. And so if you're the buyer and you can successfully negotiate a 3-month average, that's a $1.5 million impact to kind of the overall value that you're paying for that business. And then one other example on just net working capital, and there's some fluctuations in net working capital and can impact how do they have peaks and valleys within the net working capital needs of that business. Most times, if you just talk with a seller about when should I sell my business, a seller wants to sell their business when they have all the cash in the bank and no cash sitting on the balance sheet and inventory and AR. The Halloween season is coming up, and if you're selling costumes, well, the best time to sell that is in November, obviously, because you've probably collected on most of that AR, but the worst time to buy that business is in November, unless there's some way to kind of equalize things out. So in that case, we would generally suggest some type of an average over the period that includes the low season and the high season. That way it's kind of splitting the difference. And, if a seller of that Halloween store sells in November, they might have to put some money back in what's called deficient level of working capital. That way they're not kind of taking everything out that's needed and kind of splitting the difference. Now we're on to our third polling question, Amy.
All right, so third polling question here. Which types of liabilities are usually considered debt-like? Few options there. Go ahead and answer that.
All right, thank you. And this question is, when we talk about debt-like is items that, basically get paid off by the seller at closing versus what gets retained within assumed liabilities as part of net working capital. And the answer C is the right answer. It's pretty much always capital leases are considered debt-like. Current liabilities we think of usually or current credit card liabilities are usually considered net working capital. At least that's our position, just because they're basically an extension of accounts payable. And if they're not incurring actual interest, then they feel and look like accounts payable. Accounts payable well over 10 days could be considered debt-like if they're really old. If there's 90 days or 120 days old, maybe the seller should have to pay those off before the transaction occurs. And I've seen it on smaller deals that accrued vacation also can get paid off at closing if the buyer just really doesn't want to assume any employee type expenses on their balance sheet. So we've covered steps 1 through 3, and step 4 is kind of where it all comes to a head. And the whole idea is that all things equal and equally defined and pro forma and everything else that we already talked about, that buyers want to try to negotiate the highest level of net working capital target possible, and the sellers want to negotiate the lowest amount because it means that the sellers would need to deliver the lowest amount at closing compared to what the target number as negotiated is. And we always advise that sellers, if at all possible, should try to work through at least steps 1 through 3 in some way or shape or form, or at least step 1 or at least step 2 earlier, because as you go through the transaction, people get fatigued maybe, especially sellers, that this is their only time ever transacting on a business transaction. And they're, as long as they don't hit my purchase price, they can have whatever net working capital target that they want. But that means that they may, have to deliver an amount that they just can't get to. And that will erode their proceeds in a deficient working capital level. So best case is that the sellers can get the buyers to agree to some type of framework for net working capital. while they're looking at their letter of intent, instead of just leaving it completely open to interpretation, or right after the letter of intent is established. So maybe the next step is, if it depends on if the business is has a very normal type of net working capital, then it probably can wait till the end, or wait till the later stages of negotiations. If a company has really strange net working capital, like let's say that they, one example, they would sell some type of product that they need a big deposit on. If they need a big deposit on the network, on the sale in order to sell that product, then the net working capital might be actually negative compared to, they hold inventory when they receive it, but then they sell it as soon as they get it in, or it's a specialized product. Those types of situations are they're very confusing net working capital negotiations. So setting that up on the front end is probably advisable. And so, okay, so now we're finally to the point where there is a net working capital target number. If the net working capital target number is 3 million, just for example purposes, that's established and memorialized in the purchase agreement as a specific number. And then it's the seller's responsibility leading up to close. This is general kind of discussion, but in most of the deals we work on, it'll be the seller's responsibility, about 2 days ahead of time before closing, to produce the kind of estimated balance sheet at closing, which then you'll be able to calculate the estimated working capital. You can tell them basically, we think we're going to have 3.5 million of net working capital, and that's really to the seller to determine, because they're the ones who are sitting there looking at their AR, looking at what collections they're going to make, what bills they're going to pay, where's their purchase orders for inventory. So they have to kind of try to figure out what that. Nobody closes a financial statement 2 days in advance. So this will be the only time you ever do this, or a business owner will ever do this. But they're try to make it as accurate as possible, because at closing, that extra $500,000 of excess working capital gets paid to the sellers. But then, and the buyer's responsibility is just to look it over, ask any questions that they need to, but it really isn't subject to due diligence at that time, usually. If they were trying to claim it's 3 million or 4 million over excess or something crazy, then they might want to have some, more detailed discussions, and it might delay the closing. But usually in normal cases, the buyer just kind of looks it over, make sure that it looks fairly reasonable, because they're going to get their chance after closing. They'll get their chance to go in and scrub through the details, figure out what the actual net working capital is, and they'll get 60 days or 90 days to do that. And during that time, they get to close the financial statements actually, and they should try to follow the same way that the seller was preparing their financial statements in the past. But they get to have their own look at it. And sometimes they might try to add an allowance for doubtful accounts, or they might try to say, or they might actually count inventory. The seller didn't count inventory, and so as they count inventory, those are probably real adjustments, or possibly real adjustments. And then anything that the seller, anything that the buyer finds that is below that $3.5 million mark, then has to be paid back to the buyer. Or if it's above that 3.5, then additional proceeds would go to the seller. So those are kind of like the reestimate periods. And here's kind of a working example of that. At closing, you had the first column. Those are round numbers for a decent reason. I guess it doesn't sum to, or I guess the transaction expense is $750 at the bottom. But they delivered 6.9 million of net working capital versus the revised balance sheet prepared by the buyer came in at 6.4. So they had to pay back about $500,000 of that net working capital. So that's the second revaluation phase. The first revaluation phase was before, and the 6.959 would have been compared against the target number to get either excess proceeds or deficient net working capital. So during this true-up phase that we're talking about, the buyer, or the seller, excuse me, gets to go in and really evaluate in the second column, that's what the buyer proposes as their final number. The seller would then get to go in and reevaluate and understand any conclusions that the buyer made in their process, and any changes that they made, any allowance for doubtful accounts that they added, they would certainly want to understand if they added any extra liabilities to this calculation that wasn't kind of going back into the past, and especially if they're excluded items and items that in steps 1 and in steps 2 got positioned down into debt-like items or not part of the net working capital calculation. Really understanding how it plays into what was memorialized in the agreement, as well as how the negotiations went during the phases of setting that net working capital target. And with that, we have our fourth and final polling question.
That poll is now open, and the fourth poll says, what is the seller's primary objective with net working capital target? All right, let's go ahead and close this. And here are the results.
All right. So the right answer is, as the seller, you want to try to negotiate the lowest target possible. And with that, you know, how things are defined, if the definition, if you take something out of the definition of net working capital, like an other receivable, well, then it should be revalued in the same way. So just reducing it and then redefining it should get you back to kind of an even, and that should be done. But on steps 2 and 3, when you're talking about pro forma adjustments specifically, and using a 3-month average or a 6-month average, in those cases, you want to try to, as a seller, negotiate the lowest possible target.
And Kyle, the buyers are going to say, hey, we have this, you better leave this business to us with all kinds of inventory, a high receivable balance, just so that they can work those down and they get the cash then from that.
Yeah, they would say, hey, that's kind of our secret sauce. We do just in time. We understand just in time inventory. If we can reduce the level of inventory needs of this business, we'll take that cash home as our value add.
Yep. Well, I think, Kyle, just a couple of conclusionary thoughts. As I think about all the things we kind of covered here, some of the most important, I think, is just to remember that working capital means so many different things to so many different people. So as buyer, seller, make sure you're focused on that. You're talking about this. It's, as Kyle mentioned, commonly disputed at closing or true up. So really have a lot of conversation about working capital. I think we confuse people sometimes because we talk about working capital like it's a good thing sometimes, a bad thing other times. It's a good thing. If you have a lot of working capital, that means you have assets more than current liabilities. It's just we want it to be as efficiently converted to cash as we can. So we'd rather have the cash than a lot of money trapped in inventory and receivables. So that's really more about what it is. And the last thought I have is just that, do your homework, put together a team if you need some help with financial due diligence, if you need an attorney to help kind of look at some of these things, get your team together. But it's an area where the team that does the most homework, especially of a buyer, you need to have some of that scrutiny to look, as Kyle showed, not only annual type of trends, but monthly trends and explain those and normalize those. So it can be a complex process, but worth the time and the expense. Kyle, how about you? Any other last thoughts?
Yeah, I think just the only other thing is, trying to add that value. If as a seller, you want to try to start paying your vendors according to their normal terms might be a good way to add value to your current operation, and show that net working capital really can perform at a little bit lower level. Those are things to think about as you're going to market and thinking about selling. Yeah, I think those are all good ways to kind of drive value to the business owner, to the current business owner.
Well, I think that concludes our presentation. I don't see any Q&A. Amy, any other last minute housekeeping?
Nope, that's it. We just thank you all so much for attending, and thank you to our presenters. So give you guys just a few minutes back in your day. Have a great day, everyone.
Thanks.
Thank you, everybody.